welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio, and we have a guest today, Eugene Yashin. Am I pronouncing that correctly?
Yes.
Okay, great.
Very
well,
event for me, but yeah.
Well, Eugene's from Krasny Financial, and I'm sure he'll have an interesting presentation, but before we do anything, let's go over our disclaimers at the bottom of all of our web pages. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, welcome, Eugene. This is the first time you've been with us, and maybe you want to, I know Jim knows you already, so maybe, Jim, you want to introduce Eugene a little bit?
It would actually be my honor. I've been working with Eugene for some time now. Actually, Eugene, I don't know if you know this, but when they were introducing me and they described, you know, who you were when I was going to meet you, they described you as the Russian rocket scientist. Eugene is actually one of the smartest guys I know, okay, in this industry. He has spent basically a career looking at factors that make up good equity investments. You know, when we've talked before, Eugene will end up showing you how he breaks things down and looks at it on different levels. Like, for example, he'll look at small cap versus large cap. He'll look at what industries it's in, and he'll take you through how he does some of that stuff. Eugene is, for, you know, whatever title they end up wanting to put on him, he's the chief stock picker for Krasny Financial, which manages over $500 million. You know, people can say different things, but in the end, it's always going to end up being how have they done. Eugene's been at this for the better part of a decade, and he's beaten the S&P, and he's done it with less risk, no matter how you want to measure it, beta or anything else. So with that, Eugene, I'm really excited, and I want to end up thank you on behalf of the community to come in and be able to talk to us about, you know, your methodology and how you end up looking at stocks.
Oh, thank you, Jim. Thank you. I hope you didn't exaggerate too much introducing me, but okay. All right. First of all, can you see my screen okay?
Yes.
Yes, can.
Okay, perfect. So, you know, we live in this cruel world, so I have to read this important disclaimer as well. Although it's going to repeat somewhat Tom already has said, but information presented is for educational purposes only and doesn't intend to make an offer or solicitation for the sale or purchase of any specific securities, product, service, or investment strategy. Moreover, you should not assume that any of this presentation content serves as a receipt of or substitute for investment advice pertaining to any particular situation. Be sure to first consult with a qualified financial advisor, tax professional, or attorney before implementing any strategy discussed herein. Furthermore, there are no guarantees that intended results will be realized or achieved. All right, now that we've I'm not going to read this one. This one will probably, I can just kind of pause for a second.
And they can end up, they can always look at it later on. They record it. They can end up reading it if they like later.
Right, right. Let's go to the good part. So I'll briefly introduce Krasny as the firm, and Jim, you've touched upon most of it already. So we were established in 1987. Right now we have above 500 million under management, and we offer different strategies to our clients, including tactical asset allocation and individual equity strategies. We also have advanced income strategies, and we provide retirement and financial planning as well. And as Jim already touched, I'm in charge of individual equity strategies. And we run the strategies as standalone, so clients can invest in those on a standalone basis, but they also become a part of the tactical asset allocation strategies for the firm. So what we're going to talk about today, and I was thinking what would be interesting to the community of really advanced, professionals and people, individual investors who are interested in the markets. Just by chance, reading the latest financial analyst journal from CFA Institute, I ran across the article by Bruce Jacobs and Kenneth Levy called Investing in Multidimensional Market. And I found the article really interesting, and a whole bunch of arguments the authors produced actually were right on the money and jived really well with what we do as professionals. And I thought that I would kind of commingle the article and the points the authors made with what we do in real life and what works and what not. So hopefully this presentation is going to be as useful and thought-provoking as one can make it, and I will try to leave enough room for the Q&A and probably discussion afterwards. So we'll talk about investment regimes in the marketplace, how they change. We'll talk about the anomalies observed, and pretty much look at the, simple one-factor or models consisting of couple factors versus more complex but still achievable multi-factor models, and look at the pros and cons for each type. So as you all know, in the marketplace there are all kinds of investment regimes. And by investment regimes I mean, sometimes you look at the market and you see value companies outperforming growth companies. Sometimes, this year large companies were in vogue and small companies really trailed by a pretty big margin. In other situations, you see high beta stocks outperforming and low beta stocks underperforming, or vice versa. Going out of 2009, you actually saw in the later part of 2009 low safety stocks outperforming high safety stocks when people realized there wouldn't be any Armageddon. So when we look at all those regimes as active investment managers, we constantly ask ourselves, can we find a mix of factors or a single factor which would help us distinguish potential winners from potential losers? And it's always a dilemma. So that's nice. The first look of live presentation. So the one of the slides I wanted to show you was the value growth cycles. So I'll just speak to it. So the value growth cycle, if you were a value investor, you wouldn't be doing really well from 1997 through 1999. You'd be actually punished by overweighting or actually following the value factor. The same goes for growth-oriented investors if they were in game from 2000 through 2002. So actually I do want to show the factor. Hold on just one second. That's what we call live presentation. Sorry about that.
Eugene, just as you're going to do that, when you take a look at when you move from a value to a growth, or you're changing regimes, when you look at how do you take a look at that changing of the guard, so to speak, when you end up moving from one side? I guess your slide's up, so now you're going to answer the question.
Right. Sorry. So the answer is it's very tough, and it's very hard to predict. So when you are actually, what I wanted to show is, so when you are in 2000, early, late 1999, entering 2000, and you are growth-oriented investor, you are pretty much excited about your performance. And really, when we look at the graph at the left side of the graph, when we look at the historic patterns, it's very easy, to observe those cycles changing. It's much harder when you are actually, at that point in time to predict the reversal of the regime. That's why when we talk about the single individual factors, there is a risk of following one factor or two-factor models of being clearly whipsawed. So in our practice, in real world, although we were trying to predict multiple regimes, we were unsuccessful, really. And what we ended up doing is we ended up observing those regime changes. And by observing, we do smooth those cycles. So for example, you're looking at 12-month average of return differential between the Russell 3000 value minus Russell 3000 growth subuniverses. So, in the real world, it's very hard to make a switch, especially when you follow a value growth factor or price to book value factor, which, is an industry-wide standard for value growth definition. It's very hard to predict those. So, especially when you look at the period, for example, from 2004 to 2007, when you have a clear value period where value stocks outperformed, but then you would expect in this particular period to have a switch in the regime, but it kind of fakes on you and goes into the second pronounced period of value dominance. So, so with that, let's see, pros and cons of following one or very simple model. So, one of the most famous and highly publicized models is capital asset pricing model. The advantage of this model is clear. You can easily understand it. It's pretty intuitive and it's pretty appealing to the investors. The other models like momentum strategy, for example, when you follow and your main factor is momentum, it's also very easy to implement and it's easily observable. So all these models have quite a bit of appeal among institutional and also individual investors. On the flip side, for example, beta by Bruce Jacobs and Kenneth Levy, when they actually looked at quite a bit of different factors, they found that beta was not significant, statistically speaking. So beta wouldn't allow you to distinguish potential winners from potential losers. At the same time, if you were, for example, a momentum investor, you wouldn't do really well in, as I said before, in the late part of 2009, because all the companies which crashed, especially like significantly in the first part, by March 2009, then later on they were bouncing back much quicker than those more stable companies. So the other problem using simple one-factor or couple-factor models is the phenomena called factor crowding. When you have a whole bunch of people following the same factor, and what happens is when everybody's following the same thing, this thing pretty much, the signal disappears, right? So you experience adverse price pressure because the people start beating up the particular stocks with the factor which they believe would work favorably. And as a result of adverse price pressure, you have higher trading costs and so on and so forth. So on one side, easy to implement. On the other side, really doesn't give you much of an advantage when the model is well pronounced and well publicized. So what we do at Krasny, we do use multi-factor models. And when we implement those, the models allow us to be a little more opportunistic, a little more flexible. And one of the big advantages of multi-factor models is actually that they allow you to do a much more complex cross-sectional analysis. So you look at the population of stocks at certain point in time, and then you start segregating winners from losers by x-raying a company, right? By looking at all different dimensions that each particular company lives in. And this allows you to address the real complexity of the world. It's not necessarily, I give this anecdotal kind of sample example to my clients when I say, okay, so what would you call a company with high price earnings ratio? And they say, well, it should be a growth company, right? Because it has a high price price earning ratio. And I say, okay, what if the projected earnings growth and projected sales growth are dismal in comparison to their peers? They go and they pose. And usually they say, well, it's probably just a crappy company to invest in. So, but, even in a simple example, it's when you even classify a company to be a growth or a value company, you have to be careful because it's a much more complex place where the company, exists. So using multiple factors in a model allows you to be a little more consistent performance-wise. So I compare, multi-factor models to a car. You have good tires, you have good aerodynamic characteristics of a car, and you have great engine. Well, tires work really well when you turn. Engine is very important when you are accelerating, and when you're cruising, your aerodynamic characteristics actually, help the performance. So in the same kind of sense, if you find a good group of factors which work well together, and not necessarily well together, but complement each other, then you might actually end up having a very viable model, and which will allow you to perform well across different investment regimes. And obviously, when you have several factors, you can experiment with having a proprietary mix and benefiting from that. So you don't get overcrowded and you don't have this price pressure. Obviously, there are disadvantages of having a multi-factor model. Could be, first of all, there are different relationships between the factors themselves, right? So you can have a multicollinearity problem where a group of factors would correlate with each other strongly. So you don't really get the benefit of using several factors which point to the same thing. So you don't need those in one model. But it's hard to find those interrelationships sometimes. Sometimes they're circumstantial. So you have to kind of use a little bit of common sense when you build those quant models. And we do that. And also, it's kind of tough sometimes commingling strategies when they produce conflicting results on a particular stock. So for example, it's very useful and popular these days to combine value factors with momentum factors, right? So you look at undervalued stocks, and at the same time you are trying to find the stocks which started actually on the upward trajectory and have some significant, overperformance in a short period of time. Well, if you use momentum strategy, sometimes it will give you a stock which has been already bumped up and lost the value characteristics in comparison to peers. So the art of using a multi-factor model and coming up with one is to have the factors which complement each other, but do not correlate with each other. And if you achieve that, you become pretty successful. What are there are different types of factors which you can use in a particular model. So all the types of factors I listed on the right here, we use and implement. So obviously we use value factors, but as I said before, you can find a good value, but if the stock is depressed for a good reason, for a reason of no growth, then you probably shouldn't really be investing in one. So what we're trying to do, we're trying to find really undervalued companies with great value characteristics, but also with some growth prospects. And then we look at profitability and the quality of management, and there are a whole bunch of factors which describe, the quality of management and how well the companies are run, like return on assets. We look at safety characteristics, and that's one of the factors we implement and we use. So sometimes we see that safer companies outperform, sometimes we see that more adventurous companies outperform. So also the momentum, very important. Do not underestimate the power of momentum. So especially in the short-term period, it's a very powerful factor, works really well, and we use it as a part of a shorter-term model and as a part of a longer-term model. So we actually use different models for different time frames, for different time periods. And also sentiment. Behavioral finance becomes more and more important in the marketplace, and we see the more and more influence of those factors. And we constantly try to look at different ways to incorporate the sentiment into the models. I just recently was participating at Standard & Poor's conference in Washington, D.C., where they introduced, different models which are available to the marketplace right now, and there was a whole bunch of sentiment factors they look at, insider trading, institutional investors, And by insider trading, I mean legal insider trading. You can track and observe in the public reports. So, and also, the accumulation and obviously the accumulation and distribution by institutional investors following the smart money. So, with pros and cons of one-factor model and pros and cons of multi-factor models, I'd like to kind of give you a quick example of what kind of the output of such a model. So what happens when we come up and we looked at different factors, and let's say we've come up with a nice mix of factors to consider a model. So what we do usually, we test it, and we test it in sample, and we test it out of sample. And when we test it out of sample, what we're trying to see is we're trying to see that it gives us a statistical advantage over the, the average of the universe. So in this, pardon the small font here, and in this particular example, I actually presented the real model we're using. It's and we do models on the sector-by-sector basis. So in this instance, we're looking at the consumer discretionary sector, and you see that we started the out-of-sample testing from March 2010 through the end of 2013. And what we find here, if you look at this particular 57%, that's the average of, let me describe how this testing works. So what we do, we take the model, we implement the model on a sector-by-sector basis, and then we rank the stocks in each sector. And we grab 10 best stocks, and we compare the performance of these 10 best stocks we picked against the performance of 1,000 randomly picked 10 stock portfolios from this sector. And whatever the percentage of times we outperform these random portfolios, we list. So you can see that we've been successful on average 57% of the times. So every casino would grab that odds, these odds. So casino works on 52-48 split, and we are looking at 57 split. We're trying to actually achieve 65%, and I feel much more comfortable when I have a 65% win ratio, so to speak, on a particular model. So consumer discretionary, as you can see, is a little, needs some work, but overall, a particular model works really well across 10 sectors. So with that, I'd like to open a Q&A. I know I kind of probably went through this a little quicker, but I will
So Eugene, the question I think that, I've heard a lot of people end up asking in the past is that when you're thinking about a portfolio construction,
right.
A lot of people think about it within, the different regimes that you ended up mentioning. They think about, 3 different regimes. They obviously think about what sector, right? Because one of the probably the biggest issues that I've seen, okay, with my work with Krasny, when we look at an individual's portfolio, if they've been managing themselves, they tend to be hugely weighted in one sector or in, just a couple of stocks. You'll find that the technology engineer tends to end up having all of these tech-based stocks. And the rest of his portfolio is very underweighted. And so what ends up happening is he lives and dies with that one industry or that one sector. The same thing ends up happening when we think about it between small cap and large cap. And then the third dimension of that cube that a lot of people look at is you end up getting some people who are very, very big into the whole value or growth thing. You know, you get, Graham and Dodd disciples, okay, that end up wanting to end up doing value, and the value tends again to end up being in a concentrated area. So they end up having, you never just go all out into one area. You tend to end up, weighting more. What's your process? What do you do with a split of, a regime? Like, for example, when you take a look at the sectors, okay, and I think probably going through a specific example is good. You talked about consumer discretionary industry. How do you don't end up picking just a couple of sectors? Do you overweight, okay, when you end up doing this? What's your process?
Sure. Well, I see all different clients, and actually I speak not just to individual investors, but also I speak to a whole bunch of institutional clients. And believe it or not, these days most of the investors face the same issue. And what you touched upon is that especially individual investors sometimes have this preferential treatment, so to speak, right, to a particular game, to a particular factor they look at. And the biggest, as I said, the biggest mistake is to fall in love with a certain factor or a theme or sector, right? So when we look at this cube, so to speak, right, we actually have not a cube, but what we call, and you will love it, so we call it virtual cube. So by virtual cube, it means that they're not three dimensions really, but it's a multi-dimensional. It could be unlimited dimensions, but instead of looking at just value, growth, size, and sector, we're looking at a whole bunch of other things like idiosyncratic risk and all other, the volatility and some other characteristics as well. But when we look, but the first three you mentioned are the cornerstone of our decision making. And when we start composing a portfolio, we usually work with the benchmark, right? So we start from saying, okay, if we were to invest in the market, like William Sharp, right, we would go and buy everything, right, in the proportion. So let's say we start 80% Russell 1000 index and 20% Russell 2000, okay? That would represent 99.2% of the whole marketplace in the United States. What would our weights be, right? And we're saying, okay, so here's our composition. And then we're saying, okay, where are we in the value growth cycle? Where are we in the large cap versus small cap cycle? And I can tell you from our experience that, for example, the cycles have different stretches. So the style cycle you're looking at on the screen right now, it's not a coincidence that we're looking at a 12-month moving average, because usually those cycles are shorter. They are year to 2-year cycles, versus the size cycles could be really sticky. They could stretch to like a 3 to 6 years. So, so first of all, we observe where we are in a particular cycle, and accordingly we would tilt the portfolio towards value or growth or large cap or small cap, right? So we would make those tactical bets. But we're not trying to predict where we are in the cycle. We're just observing where we are in the cycle and how far we are in the cycle, okay? And also, with regards to sectors, we do use the, we do use the posture and size and style as kind of the leaders to our sector composition. But once we come up with the sector weights, we also use the proprietary score, which is based on the individual company scores. We're just wrapping them up into sectors, and we overweight the sectors with more opportunities. So if you see, for example, an IT sector with more companies, high-scoring companies than utilities, then we overweight an IT sector, and we underweight utilities.
And by definition, when you say overweight, can you give us an example? Like, do you use the percentages that make up the Russell 1000, the S&P 500, and how far would you end up overweighting? Would you double the weight of one sector?
Sure. We wouldn't. The combination of Russell 1000 value, Russell 1000 growth, Russell 2000 value, Russell 2000 growth, right? So we got, and the composition of those indices is public. So you grab the composition, and let's say for the simplicity of the example, we'll go 80-20, right? So we'll get 80%, so 40% Russell 1000 value, 40% Russell 1000 growth, 10% Russell 2000 value growth each. So, and then you come up with the sector weights, right? And then you say, okay, you have double the number of attractive companies in IT sector versus that in consumer staples. So what do you do? Usually what we do is we underweight by, it also depends on how many positions you have in the portfolio. So we run quite concentrated portfolios. So let's say we have, for the simplicity again of the example, 36 or 40 positions in the portfolio. So with 40 positions, if you have 10 sectors, you have probably in the largest sectors you have 5-6 positions, and in the smaller sector you have 2 to 3 positions. So what it means, if we see a huge signal, like double attractive companies in one sector versus the other, we wouldn't double the sector, but we would overweight the sector by the magnitude of dominance. So we normalize the scores for each sector. So if one sector gets 1 standard deviation or 2 standard deviations more of appealing firms, we would say each standard deviation will reward that with an additional position. So in other words, to be simple, if you see twice as much number of attractive positions in IT, I would get 2 more positions in IT, and I would take away 2 positions from the less appealing sectors. Okay. So we could have pretty aggressive tilts sector-wise. So we could have, for example, I'll give you an example. We ran financial sector probably 6% below the benchmark. So if the financial, for a while, so if the financial sector would have 22% in the overall portfolio, if we were following just the index compositions, we would run like at 16%. So it's a fairly significant tilt away from one sector. And the same goes for information technology. So when we saw the information technology actually being really promising, we would overweight from, let's say, 18% or 20% to 25, 26%. Fairly aggressive tilts. Again, with value and growth, the same way. We would start 50-50, but we could go, like, for example, when you found yourself in a significantly pronounced growth domination period in 2010, you wanted to be overweight in growth. So the tilt could be as big as 70-30. So we would tilt 70% of the portfolio to growth and would leave 30% in value. When you start hitting the territory we are in right now, it becomes really tricky, right? Because, if I ask you, Jim, what do you think? Where are we going from here? How are we going into growth? How are we growing into value? It seemed like we were going back to value when, we started hearing the doubts about the GDP, the world economy. People were going for utilities. People were going for consumer staples. And that drove really this, movement towards value. But all of a sudden you see, more countries going into quant easings, Japan, China. You see U.S. doing much better and really pulling the world out of the potential recession. And all of a sudden you see the appetite for growth coming back. And so it's a $1 million question. So at this point we're becoming much more neutral. So we would stand at the 50-50 game.
Okay.
Potentially.
A couple other questions in the chat. First one is, I know you use individual equities. I don't think you use ETFs, do you?
Well, that's a very good question. So recently we started getting more and more requests from clients. And just recently we actually did this study where we looked at the industries. So I spoke about sectors and having tilts in sectors, and we've used a whole bunch of vendors and analytical shops which provided industry ratings, right? So what we said, okay, let's try and see if we can come up with our own industry ratings. So what we did did follow the same logic, kind of organized industries. Out of 200 industries, we selected 85 investable industries, so they don't have one shoemaker, It could be like a little, needed to be a little smaller. You'd be surprised, but that's a real example. So we would have 85 good industries, and we came up with the individual industry rating, and it was fabulous. We looked at the 5% alpha, just having a portfolio of 10 industries versus 40 individual stocks. And believe it or not, but those good industries from period to period were pretty sticky from quarter to quarter, but also pretty diversified. So you wouldn't run into risk of buying drillers, oil producers, integrated oil. It was fairly diversified group of industries. So we were very excited. So we said, great, the next logical step would be finding the ETFs for those industries. And that's where you hit the roadblock, because ETFs, existing ETFs, and we looked at the XTF, ETF, DB, all known databases, Morningstar. But in a nutshell, you're working when you look at ETFs, equity ETFs. You have about 500 ETFs which describe industries to one extent or another. So we grab those 500, and having the computer power and quant team behind my back and being cheap as we are, we pretty much crawled all the ETFs and their compositions. And what we found out is that we cannot really map the ETFs to industries, because, well, I'll give you one example. For example, you grab a transportation ETF. Well, you have trucking, railroads, and air transportation, all three industries in one ETF, right? So when you have all three industries being attractive, that's a clear winner. Well, what if you have one or two? So, and that becomes a challenge when you go from the more academic exercise of looking at the industries into the real world exercise of finding the ETFs, which would clearly represent these industries.
So that's the problem, right? Because a sector is bigger, and there are a lot of sector funds out there, but a sector is usually made up of multiple industries, and sometimes, part of the sector, some of the industries are doing well, and some aren't, but you don't get that. You get the entire thing. And the challenge, what I've always seen with any of these ETFs, how did they put it together? How did they end up defining it? It was whatever they could sell, whatever was hot and what could sell. So there aren't sometimes the delineation between the sector groups or the industries that I know that you would like.
Right, and you're absolutely right on the money here. And I think one of the, we do have, the strategy in works where we work with 10 sectors. And I know how you love S&P 500, Jim. So, you can grab those.
Well, I'm an options guy. I like liquidity.
I know. Well, and those spiders, they're pretty liquid, right, in comparison to some ETFs.
Hey, you know what? We spend so much time on disclaimer, I got to give you a quick disclaimer joke. Okay. So when I was doing a presentation for your company once, I ended up saying that the options on the spiders were extremely liquid or highly liquid.
Right.
And your compliance guys made me take it out. And I made a deal with them. I said, if you can show me any other security other than the S&P 500 that does more dollar volume, okay, in the world on any other contract, I won't end up saying highly liquid. I didn't say the most liquid in the world. I just said highly liquid.
Right.
Okay. They let it go finally. But, you kind of end up joking about it. But yeah, that is one of the challenges that, as an options guy, because we need to have a ton of liquidity, not only in the underlying, but then also in the options, because our options can end up getting to be so they ask that it really makes them uninvestable. It's a little bit different for you because you're going for the equities. Now, when you end up doing this, do you end up using the same size for all of your positions? That was another question. The same size for all of your positions across the portfolio?
Well, once the portfolio is live, and we've been at it for a while, the weights kind of deviate, right? So what we are not running the 3% across the board type of portfolio. So we allow a position to grow up, and what we have a nice, very strict discipline, and we don't want also to be dependent on the position. I'll give you an example. We had Apple going from 250, like everybody knows, to 700, and the position was 6.5% of the portfolio. And we trimmed it a little bit, but not enough, and then we got hurt. after, Apple went down. So we are trying at this point to allow the position to grow to 4%, 4.5%, but then we would trim it and offset the capital gains with some of the position, lost and produced capital losses. So we kind of leveling the field this way, but at the same time, we do not get caught in the position becoming too hot and then, getting hurt on a particular quarter when the position, when the company underperformed or whatnot. We do have very strict selling criteria. So if we don't sell the position but it grows to large enough, we will trim it. We will, keep it, but we'll trim it.
You've looked at a lot of portfolios. One of the things that I've been doing with your company is that how many times have you gone in? But by the way, Krasny, and we didn't say this in the beginning, Krasny, Eugene's company, is one of the recommended advisors on the Advisor Direct platform for both TD Ameritrade and for Scottrade. So if you walked into any branch and you wanted to end up seeing a portfolio like this, your advisor would be able to end up being able to get Eugene or his team, to be able to talk to you, or you can always contact Eugene directly. But how many times have you looked at somebody's portfolio and 40, 50, 90% of their portfolio is in, one or just a couple of individual stock equities?
Way too many times.
One of the things that we started to end up doing, with you guys, because we do a lot of the risk management and the options stuff as a team, we started to take a look at how to end up protecting individual positions. Because, but the thing that I want everybody to end up hearing, Eugene ended up saying that when one position got to be 6% or 6.5%, it was way too big in the portfolio. So they cut it down to end up having a maximum of 4 or 4.5%. That's nowhere close to, I'd say, the majority of people's portfolios. When I've taken a look at portfolios, a lot of times you end up, even if they are diversified, they might end up having, 5 to 10 stocks, and they have, 10, 15, 20% in individual positions, where single positions can really end up hurting them. I think that what ends up happening when you become more diversified, it takes a lot more work. I one time, and I forgot who said this, I wish I could give credit to where I heard it from, said that often wealth is created through a concentration of risk. Wealth is preserved through a diversification of risk. So when I take a look at what you're trying to accomplish, you're not trying to end up doing 4 times the S&P 500 one year. You're looking for incrementally beating it with lower risk. I mean, to me, that is the way where the safer money, the non-gambling money ends up going, or at least the way it should end up being. And I think that for individuals that end up having a concentration of risk, that they really, really should end up taking a look at a way of being able to end up, seeing how they can end up lowering that. There were a couple of other quick questions here that I wanted to end up asking that were written. The first one here was that when you see that there is a predominant weighting in the value stocks versus the growth stocks, is that bullish for the overall market?
That's a great question. That's a great question. And,
By the way, that wasn't me. That was Stephen, okay? The smart questions never come from me. They come from our audience.
Okay. Nice. Yeah, yes and no. So here's the when you first of all when you see the pronounced regime, and as a matter of fact, we just observed for the last from 2001 through 2010, if you looked at the overperformance of value versus growth on the cumulative way, you would see. I'll go back here real quick. I'm in different presentation again. It's killing me. I'm sorry. I'll be much more versed next time. But so when you look at this particular period of 2000 through 2007, right, you'd see a huge value dominance. The problem with the recent few years was that this discrepancy really got washed out. So I want to warn you right now that and that's what happens as well, that we're moving in a changing times, right? And the market changes as well. So right now we see in the marketplace actually a whole bunch of growth stocks with real good value characteristics. So when historically we would say yes, when value stocks start outperforming, look for the for the bull market, etc. Well, because we're living in a very low interest rate environment, people started looking for yields, and they couldn't find those yields in the bond marketplace. So what they ended up doing is buying utilities, consumer stationery, all those higher yielding stocks. So when you saw this huge wave of income-seeking investors competing for the value stocks, what they ended up doing, they ended up beating up the value segment of the market. Well, is it the indicator in itself of the continued bull market? I would argue no at this point, because right now we see a whole bunch of value in growth stocks and traditionally growth industries like IT, portions of healthcare, in some of the consumer discretionary areas, versus traditional, like if you look at the PE of utilities or MLPs, sometimes they're in like 20s, which is unheard of by historical, measure. So I would be really cautious about making calls from now until we get to more, until interest rates kind of get adjusted from really historic lows, to get back on this trail of thought that value stocks really, that the dominance of value stocks is a predictor of the future bull market.
It is. It's a very interesting question. It's a very intellectual one. There's a lot of parts to that answer. Our members use a lot of different tools to kind of do scans, and they tend to end up doing it first using scanning tools maybe for fundamentals, things like the American Association of Independent Investors, right, AAII, they have a tool called Stock Investor Pro. I know some people use that. A lot of people end up using finviz.com. Paul Demers showed in Trading Group 1, I forgot the name of the software, but it ended up doing a lot of scanning also. If you could take a look at just a few individual factors within any of those areas, the individual things, what would be some of the things on your don't miss list, okay, that you'd recommend to anybody starting out trying to understand the fundamentals of a company?
Right. Well, I would, first of all, I would encourage people to do two things. First of all, going top down and then bottom up. Okay? So I would encourage people to look at those cycles and regimes, which are easily observable. You can go on Google and type in Russell 1000 growth, Russell 1000 value, Russell 2000 growth, Russell 2000 value, and see how they've done for a year, 5 years, et cetera, and you can, this year was a clear size dominance factor, and try to see where you are in the cycles, right? And there's a whole bunch of literature. Then, when you look which factors are really dominant in this particular regime, you could go back to the, scanning tools. And what I encourage you to do is to look at the combination. Never look at one factor. Look at the combination of factors. And no matter what they tell you, I've spoken to gazillion institutional investors, participated in the conferences, et cetera. Pretty much the mix I've listed here is something 80, I don't know how many percent, but the majority of institutional investors look at. Okay, so your value factors, your growth factors, even by looking at commingling a good value with decent growth prospects would give you already a good list of potential companies. And obviously as I said, momentum is a big thing, and sometimes, it does pay to follow smart money as well. So those are the areas which are very kind of easy to implement in those readily available scanners.
I have a last question here. Anybody else, if you have any questions, type them in. Last question is that, when we're talking about, diversification, first of all, to the person who asked the question, Eugene is an equity guy, but how does Krasny, and I realize this is beyond your realm, there's also another person who looks at a broader section. How do you look about diversifying outside of equities? Do you have models where you'll look at either bonds or futures or commodities or currencies? How do you end up taking a look at the bigger picture?
Right. Well, we have, I work also with Steve Tuttle, who should be answering that question, but so
I laugh because when I get asked that question, I said, speak to Steve. What we'll do is maybe after the new year, we'll have Steve come on because I have seen him do that that macro trend presentation that he does for all of your clients on a quarterly basis.
Right. But in essence, I mean, he will be a much better person to answer that, but he does look at the economic cycles. He does look at the predictions. He does look at the, just to give you, a quick example, when we were discussing where would we go with regards to where are we, in the middle of the expansion, in the later part of the expansion, all the indicators 3 months ago, 4 months ago, were pointing to mid to the later stage of the expansion of the economic cycle. And all of a sudden, because of kind of a reset across the globe, and accelerated nature of U.S. economy, all of a sudden we found ourselves in a more of a early stage expansion condition again. So he'll be a much more interesting speaker in that regard, but when we work with him and I get the input from him for equity, but also when we do the bottom-up sector rating, I give him my feedback, what the the signals from the ground tell us. For example, energy four months ago was a hot sector. Not anymore. Thank you very much. Quantitative factors, but yes, so that's happening.
$59 oil today. $59.
Yes, and and no energy in particular. It's a very tough area, and if somebody tells you that he can predict oil prices, you can call him on that.
So actually the thing is that I did make a prediction. I made a prediction about almost 3 months ago at this point, because I made the prediction. I was joking. My former trading partner, a lot of the members might know him. His name is Stephen Shannon. Stephen bought a Tesla, and I bought a Prius. So when oil was at $100, I made the joke that it was going to 20. We're halfway there. I was only joking, though. Okay.
Okay, next time you're shopping, I want to be on the short call.
You'll be my first call, I promise. Eugene, we've been going just about an hour right now. If people want to end up getting in contact with you, if they have more questions, if they want to know about, your portfolio, how can they end up getting in touch with you?
Right. I'm juggling through my approved presentations here. Here you go. So the best way would be by email. I'm 24/7. I'm like 7-Eleven of investment world. So I'm on email all the time, and I respond usually within 24 hours. So.
Yeah, no, I know, and I have done that. If you have any questions, you can write to Eugene. Also, you can always end up going to either Tom or myself, and we'll make sure that Eugene gets the questions. But Eugene, I found this to be really, really interesting. One of the things that Eugene has agreed to end up working with, our community is that for his stocks that he ends up doing with his clients, those are sacred. We can't end up touching them. But the 37th best company in the market is a really nice one to end up looking at for covered calls. So what we'll end up doing is starting next quarter, sometime in the, hopefully, the January, February timeframe, we'll take a look at Eugene's analysis. We'll work with him, and then I'll end up doing some of the quantitative work in and around taking a look at covered call strategies on those individual stocks. Now remember, Eugene isn't doing a lot of covered call stuff on individual positions, so the liquidity that he ends up needing for his portfolio is going to be less than what we would usually end up recommending for any type of a options-based play. So we're going to end up starting that hopefully in the January, probably February timeframe. He and I will work on that together, and we'll be able to end up presenting that. So I'm really looking forward to working with you on that, Eugene. Thank you.
Sounds good. And do not get discouraged by the 37th status, because usually we end up with a whole bunch of great companies we just can't buy into due to the constraints of the portfolio. So it's not 37 by quality, it's just circumstantial,
Oh, yeah, no, I was just picking a number because I know that your portfolio tends to be around 36 stocks or so.
That is correct, yes.
So anyway, we really appreciate it. Thank you so much for coming and sharing your knowledge with us, and we hope that to have you back next quarter.
Thank you so much for having me, and please do not hesitate to write to me with all the questions you might have.
Yeah, thanks,
Great.
Eugene.
You have a great day.
Thank you.
Thanks, everyone.